I'm teasing. You got a sense of humor, Gabby?
Yeah.
All right, you better work on it. I can see he's going, whoa, this guy. So because of your personality, you got to use it now. It's a gift. You communicate to people, and people listen to you. Now, let me be really clear. 5 years ago, nobody wanted to hear from you. When you came, everybody wanted to leave immediately. Uh-oh, he's here. Everybody, all of a sudden they turned this way. When he came in that way, they all turned this way. That's not true anymore. Did you know that?
Probably.
You said all the wrong things. You're terribly inappropriate. You said there was a nice side and a stupid side.
Yeah, there's no more stupid side.
I get that. That's why I'm having this conversation in front of everybody. It's okay. You're okay with it, right?
Yeah, absolutely.
See, it's another gift. He's okay with it. That's personal growth and development right there. So he's using his intelligence and his charisma and charm now to say the right things. And he's soaking it up, and he wants to learn, and he's giving it back out. And are you getting results?
Yeah.
All right, now it's time to close and get concrete results.
Well, I figured it out what the problem is.
Okay, what is it?
First thing is I had like 8 or so people that I had begun the process with, and I cordoned it off and was like, I want to close with all these people. I should have never cordoned it off. I should have, because I can always reapproach these people and just have them in rows of time frames. Second thing I realized yesterday is I text people. I don't call them, I text them. And if I text them, they can look at it and put it down and go back to what they're doing.
The best communication is eyeball to eyeball, kneecap to kneecap, belly to belly. Never
So
change.
I'm basically using like what the 3rd or 4th greatest form of communication. I should be calling.
Amen.
If they can't pick up, they can't pick up. At least they'll know.
Right, and get commitments. No question about it. Follow up, follow up, follow up.
So I've got a bunch of people I'm following up that I keep on trying to get a hold of with text messaging.
Good.
And it's just not as easy.
So here we go. And then I'm going to tell my story. And then Shane, Ryan, are we almost ready?
Yeah.
Should I keep going or just hold up and start going, doing what we're supposed to do?
I'm ready to go.
All right. So here we go. So Tony, do us a favor. Will you do us a favor?
Yes, sir.
Will you introduce Shane Urbana and the opportunity? Let me get out my little thing. Because Gabby wants to know, and so does Francisco. Because Francisco, he's learning all the time, and he's understudying, and he wants to learn how to talk about this so he can attract attention.
Hold on. What part we should have Tony do a part of the briefing, right?
All right, you call that play there, Bunk. Which part?
What part do you want to do, Tony?
First, I'll do your part. I'm more familiar with that. I've done yours like 3 times and his once.
Okay.
Okay. So welcome, Gabby.
Is this
Welcome
live
back,
now?
everybody
Is this
else.
live?
Mm-hmm.
Oh God, I'm on YouTube. Okay. Anyway, welcome to our weekly opportunity briefing. Thank you, everyone, for the gift of your time and energy to come out here. We have extraordinary opportunities and transformational ideas that we believe are morally and mathematically as good as it gets. And we speak boldly, and we believe we have what it takes to back what we say. You don't have to defend the truth. So without further ado, because we're a bit behind, let me introduce myself. I'm Anthony Cariolo. I've been in Empower for about 6 months, but about 4.5 I spent laying on my couch watching television. So I'm really taking it seriously, and this is just like the gym. You get out what you put in. And if you're not repping and if you're not repeating and getting better every day, you're not going to get any fitter. So let's begin.
Well, coming.
Is that okay?
Well, that was good, yeah.
Am I doing all right?
Now, you forgot to tell them to please put up their phone.
Oh.
You know, that
Yeah,
kind of
please
stuff.
silence your cell phones, put it on vibrate, whatever you have to do to give us your undivided attention, because we do have a lot of information to go over, and you will have a lot of holes, but we'll plug those gaps and sharpen it up.
Anthony may help out before you go. And then the other thing you could have asked, that they're here for one of 2 reasons, because you were invited here, so thank you for your time and the gift of your time. And you're going to learn a lot. Don't be overwhelmed. We're just going to show you things that you've never seen before, and there's either the services are definitely for you and or the opportunity, or both.
Okay,
Just keep an open mind.
sounds good.
Okay, that's great.
All righty. So moving forward, give me a click. So we believe there are 6 concrete steps to financial security, and if you don't have all 6, you're truly not safe. And if you don't have them, you have holes. We call it Swiss cheese finance. So step 1 Trey, what does it say?
Increase cash flow.
So there's two ways to increase your cash flow, right, Gabby? You can decrease expenses or make more money. And which one do you think is better?
To make more money.
Absolutely. You don't want to start eating more ramen to pay your rent. You want to make more money so you can get the better pasta and still make your rent. So you need to have money coming in order to address your debts, your expenses, and the only way to do that, make your life better, is pull in more. The second, what does that say, Joyce?
Establish an emergency account.
So we coach that an individual should have 6 months of their savings established in an emergency account for any event that causes them to go into remission. Most people don't even have a savings account, let alone an emergency account. So we coach people to prepare to lose an entire half year, and we give people the opportunity to do that. How many people here agree that debt stinks? It's a drag, and millions and millions and millions, most of us are in some form of debt, and it consistently piles on itself and gets worse and worse and worse. We give people the ability to manage and eradicate their debt in the most expedient way possible, because if you can't get to zero, you can't get into the plus. And we show people what the banks are doing to them and how we can leapfrog past what they're doing and make what they're doing play into our hands. The fourth one. All right, Gabby, what does that say?
Ensure proper protection.
We like to use a lot of tacky acronyms and cliches. So this one we call EPP. And think of all the things in your life that you insure. Your home, your rent, your car, your health, maybe even your phone, an expensive appliance. What's the one thing that people don't insure that they need every single day?
Income.
Income.
Money.
The only way you insure your income as an American is if you punch the clock. And if you lose the opportunity to perform any or all of your job functions for a long period of time, you're going to liquidate whatever assets you have, and you're going to immediately go into default. 72% of bankruptcies in the United States are as a result of medical bills, because it pays for your health, but it doesn't pay for you to miss work. And we give people the opportunity to recover safely without having to worry about their physical health and their financial health. Number 5, build long-term savings. We teach people to, hold on a minute.
BLT.
I'm sorry, I don't feel well. I'm a little lightheaded.
Chair.
Would you like to sit?
Yeah, I just don't feel right.
Okay, so move it up.
Sorry, Shane.
That's okay.
All right, so build long-term savings. I want to get some water, Tony.
I got vitamin water.
I'm sick.
You got vitamin water? Would you like some vitamin water?
Yeah, I'm going to be fine. I feel sick.
Okay, that's all right. Keep going. Keep going.
So build long-term savings is just a simple principle. I'm Shane, by the way. We went to high school together. Yeah. So when we get paid, you're not working right now, right? But you've gotten paid before, haven't you? When you got paid, where does that money go first, right? To either your rent, mortgage, if you're in debt, to pay debt. If you buy groceries, everybody eats food, right? You go to the grocery store, car insurance, you got to take care of all your expenses. And then the people that get paid last are us, right? Us and our families come last when we make money. So we coach people, number 5, build long-term savings, to think a little bit differently about what happens when they make that money. And it's called pay yourself first. So, you know, the question is your landlord or the grocery store clerk or the Geico car insurance representative, are they going to pay you later in life when you need money? Maybe you can't work. The answer is no, right? No one's going to be there for you except for you. You can't expect it to be any different than that. So build long-term savings is just a principle. We coach people to pay themselves first, take care of everything else after that. Make a commitment to yourself, because you're the one that can take care of yourself in the long run. And that's not like a live off the grid type of thing, like stop paying your expenses. It doesn't mean that at all. It's really almost like a mental shift and a commitment you got to make then you start to build long-term savings, and all of a sudden you have savings, and all of a sudden you almost accomplish number 2, which Tony went over, and that's establish an emergency account. And the last one is number 6, that's preserve your estate. I always tell you guys about the Biltmore estate, and one of my friends sent me a picture of it today because he was standing in front of it in a pair of rugby shorts. And so I always tell that story because I grew up knowing the word estate, but just being confused about its meaning. I always thought that an estate was a huge home. And that picture my friend sent me is in front of the Biltmore estate, which is a huge home. It's a mansion, tourist attraction in North Carolina. Preserve your estate means much more than that, right? Because your estate, I'm not standing in front of the camera, am I? There we go. So your estate can be good or bad, right? It's a combination of what you own and what you owe. So some people say, yeah, I'm going to inherit a great estate. Well, that means that someone in their family is going to pass down a lot of wealth to them. You can also inherit a bad estate. If somebody in your family that you're in their downline, you're in their bloodline, you take on their estate and they owed $30,000 in credit card debt, then that's not the kind of estate you want to take in. So preserve your estate is a simple way to avoid lawyers, judges, attorneys, because even after you're dead, even the government tries to tax you. It's true. So preserve your estate is what we teach people, how to just avoid all kinds of messes as they get older and have to start thinking about those things. So we'll move on, Ryan, and we got an opportunity tonight to educate a couple people, and it's the new year, so we're happy to have anybody who's here after the holidays. So welcome. We're Empower, and we kind of brand ourselves as a consumer advocacy group. So try to say that 5 times fast when you go home tonight, okay? Consumer advocacy group. We say that for a lot of reasons, and we love it because we really just love to advocate for people, help people. Nobody in here is passionate about anything more than helping people out. That's what we do. So I wanted this magazine in my hand to give you an idea what that means. Consumer advocacy. This is Consumer Reports magazine. You ever seen this before? Anybody ever seen this magazine, or are you a subscriber, Trey?
I am not.
You're not a subscriber. All right, well then you're missing out on nonprofit, unbiased reporting on the latest products, services that are offered mostly in America. So this is this is car insurance. They rate banks, retirement accounts, and they tell you what's the best quality, what's the best longevity, what's going to cost you the least, what's the best value. They tell you those things. We've done that too in the utility industry, energy. We help businesses, nonprofits, companies do a lot of things. But right here, we're not here to talk about utility or energy because here in Florida, you got to pay FPNL, right? Florida Power and Light, you don't have a choice. However, we as people who want to help others have found financial services, investments, insurance, getting people out of debt, and doing that all, serving people that service for free. We found that's a great way to advocate for consumers because the financial world has changed, right? This is not the 70s, 80s, 90s. It's not even the 2000s anymore. We're kind of up to date on what's going on, and we know some very easy ways to accomplish all 6 of those steps that Tony and I went over. The 6 steps to financial security. We really accomplished those in 2 ways. We're going to go over those 2 ways tonight. So you're going to see that a lot of us, if you want to go to the next slide, are athletes in our company. A lot of us are young people. And the person, Bear Bryant, on the screen, anybody ever heard of Bear Bryant? What's your name? Raphael? You ever heard of Bear Bryant? What's that? Well, I don't even know what he played, but he's a football coach. He was a college football coach. So yeah, he's a little bit behind our time, but he was a legend because he won a lot of national championships, and he brought like losing teams into winning environments. Texas A&M, Alabama, that's what he's most known for. And we liken his phrase that offense sells tickets, defense wins championships, and we feel it should be the same with our money, right? With our money, people who make a lot of money need to play a lot of defense, don't they? If you make a lot of money, you all of a sudden get a couple more cousins, a couple more uncles, and people, and you go up in tax bracket, and then one of those uncles is Uncle Sam, right? So we got to play defense. So we do that in our finances too. So we'll go over defensive strategies for your money, and think about if you're doing any of these strategies with your money, and I'll explain them. So defensively, we do 3 major things. Number 1 Gabby, is market loss. You ever heard of the stock market?
Yeah.
What do you know about the stock market? Not a whole lot. That's okay. Most people know what they know the word stock market. Really don't know what that means though, right? So stock market is, if you're working, a lot of people that work have qualified plans. They don't even know it. I was a teacher for 3 years. I had a qualified plan. I didn't even know it until my second year. I was paying money into it, $160 a month into a 401k. So my money was in the market, the stock market, right? That's invested by a money management company. People who I don't even know are redirecting my money into places where they hope it'll be safe. It's really all just hope because we don't really know what the market will do. It's done crazy things, even in our lifetimes. Us that are young in here, we've seen it do crazy things. You don't have to go all the way back to the 1920s, Great Depression, to think about times where our stock market has devastated people or the opposite. So market loss, we defend ourselves against that. And number two, fees and commissions. Remember those people I mentioned that I don't even know who are managing my money in that 401k? Okay, $160 a month as a teacher. So fees and commissions, you know, those people were not volunteers. They're not from Habitat for Humanity or the United Way. They're just people who are working jobs and they get paid on fees and commissions. Where do those fees and commissions come from?
You.
Exactly. And remember, they don't know me. And remember this big theme. They get paid those fees and commissions whether I win or lose. Who has the risk?
You.
You do.
Yeah. And yet they still get paid. So fees and commissions, we don't believe people should be subject to that, nor should they be subject to market loss. And finally, if you could opt out of the tax system for your retirement, how soon would you want to know how to do that? By the way, completely legally, morally, ethically, logically, mathematically, you name it. We teach folks how to take their retirement out of the tax system. Pay tax all your life. Why do it when you need the money the most? Okay? So offensively, everybody understand defense? Okay? Because it's not how much you make, it's how much you keep. And if you play good defense, you get to keep a bunch. Okay? Spendable income is the most important income. Offensively, want to have growth. So you work so hard for your money, you got to make it too, so might as well bring up income. Right? Growth and income go hand in hand because the best time to grow your money isn't when you need it later. The best time to grow your money is when you're making it. Okay? So you want to have growth. You go to work, you work so hard for your money, you should have it working for you, not just sitting there stagnant. If you're not growing, you're what? Dying, right? So if you believe that, then you know what I'm talking about. Next. We believe that safety is an offensive tool. We're going to show you a mathematical formula next called the Rule of 72. It's going to really teach you the power of compounding interest. And we're going to show it to you in terms of how money grows. Keep in mind, though, it works the same way in terms of how money subtracts and goes down with percentage points. Having safety is so important because when you lose money in the market, perhaps, you also lose the time and the power to ever make that money back. Might sound confusing. It was to me at first. I'm horrible at math. When you can really wrap your head around it, though, you obtain a positive and powerful tool in finance. So that's what we're here to teach you that. So next one is my favorite. That's liquidity. Remember that account I told you about, $160 a month, paid fees and commissions to people I didn't know, and had my money subject to market loss? Well, I also didn't have something I really wanted, which was liquidity. If you work a job full-time and pay into a 401k or an IRA, you also don't have liquidity because there's all kinds of rules, caps on what you can put in. You got to turn 59 and a half to have that money, free access to it. If you want it any earlier, if you have an emergency, you know, someone in your family gets really sick, you need to pay for their surgery, can't take it out. You got to sign a bunch of forms and they'll take 20% from your pocket. So liquidity just means full, free and easy access to your money. So if you have cash, you have free liquidity, don't you? Mm-hmm. Okay? You can't just grow cash sitting there. That's why you put money in accounts. We like to choose the type of accounts that have liquidity and safety and growth. Okay? So tax efficiency is the last one. We already talked about that. Why pay taxes in your retirement when you need the most if you can avoid it? Anybody love paying taxes? Nobody loves paying taxes?
Nope.
Well, I like the streets to be, you know, drivable and clean. I like the schools to teach kids well. That's about it, you know. Other than that, I think we should be able to run our own lives, and taxes are great. I'd like to keep my retirement income, though. So we're going to move on, and you're going to hear from another great speaker, former scientist. He's going to teach you about the that Rule 72 I mentioned to you all, it's about compounding interest, and it kind of makes you understand why all these are so important. So keep thinking about them in terms of your own finances. I'm going to bring up Ryan.
Very weak. Very weak. So we got to get Raphael, right? And Gabby. Okay. Just want to get that straight before I went forward. I'm Ryan. For those of you who don't know me, I formerly was a biologist. I got my grad degree over at FGCU. So math is kind of my thing. The science and math go hand in hand, right? Math isn't that bad, right? Who likes math? Anyone? Okay, we got a couple. You sure you like math?
I do. I don't like geometry and algebra. No.
Okay, so no shapes. We're gonna stay away from shapes here.
But
We're
I
gonna
like
talk about math.
Balancing checkbooks. I do
Okay.
like that.
All right, good. So here we go. This guy. Anybody recognize this guy? Albert Einstein, right? Pretty smart dude, would you say? Very smart dude. And a great hairdo too. So he came up with the Rule 72. He's the one who discovered it and put it down on paper. The equation is actually very complex when you look at the real actual equation, but simplified, all it is that he said actually that this is the greatest mathematical discovery of all time. Bert himself said that. So if he said that, I'm going to listen because he's one of the smartest guys of all time. So what it does is the Rule 72 tells you how money doubles with compounding interest. So how long does it take for your money to double with any given interest rate that you're earning on your money or that you're paying on your debts? So it goes both ways, right? So divide, you're going too fast for me here. So divide an interest rate, whatever interest rate you're getting, you divide that into 72, and whatever the result of that simple division equation is, that's how many years it's going to take for your money to double on itself. So for example, 72 divided by 1 is what? 72. Yeah, Trey. That means that your money at a 1% interest rate is going to double every 72 years, right? Follow everyone? Okay. So here we go. We're going to do an example of this. So age, and who's 23 in here? Anybody? Oh, yeah. Yeah, he's 23. Okay, so I'm going to use you as an example then. This is you. So say you saved up $5,000 from working, you put it in a savings account, but you want to go and invest your money or put it away somewhere. And I just opened up a bank down the road from your house. And since we're buds, you're going to come to my bank and I'm going to make you a super good deal. And I'm going to give you something like let's say I'm going to give you a brand new surround sound system for your TV. Is that a good deal? Just for depositing your money into my bank.
Yeah.
That's it. And a lollipop of your choice. Good? You in?
I'm in.
How about you, Raphael? You in? Would you come to my bank? And a surround sound system. More than that, you're going to get a stuffed unicorn over at Wells Fargo. So you better come to my bank instead. So 72, I'm also going to give you, well, you're 23 now too. So that's awesome. Yeah, I gave you years on your life, a surround sound system. I'm also going to give you 2% on your money. So what does anybody know right now what banks are paying on regular passbook savings accounts? Not very much. It has increased very slightly in the recent past, but previous to that, it was about 0.02%. So 100 times less than what I'm paying right now. So I'm giving you 100 times the normal bank account interest rate, a stereo system, years back on your life, and any flavor lollipop you want. You're coming to my bank, right? Okay, good. So here we go. You come to my bank and put $5,000 in, then 72 divided by 2, because I'm giving you 2%, is 36 years. So 36 years later, you're 59 years old and you have $10,000, right? So let's go another 36 years, you're 95, hopefully you're not pushing up daisies. And if you're still around, you got $20,000. So Raphael, what are you gonna do with $20,000 70 years from now at 95 years old? Nothing? Why not? Well, if you're not though.
Scooter, we'll round out and takes off.
You're right. So think about this. A brand new car 70 years ago, what did it cost?
Oh, $2,000.
If that, $2,000. Now it costs an average of about $38,000.
So you go 70 years into the future, a $38,000 car is now going to cost you exponentially more than that. So $20,000 70 years from now is probably going to buy you a juice box or something, you know, nothing major. So woohoo, there's sarcasm built into this. So I'm going to sweeten the deal a little bit for you guys because you're my friends, live down the street from the Bank of Ryan. So I'm going to give you 6% on your money instead of 2%. So I'm tripling your interest rate from where it was, right? And then 72 divided by 6 is 12 years now. So I'm cutting the doubling time down into 1/3 of what it was. So I'm tripling the interest rate and cutting the doubling time down into 1/3 of what it was. Same 23, same $5,000. What are you going to have at 95 years old? Take a shot. Just take a guess. So if you had 20,000 here, I triple the interest rate, cut the doubling time into 1/3. 60,000? All right, Rock, what do you got? 60,000? All right, great. This is awesome because I'm going to make you a deal. I'm going to give you the stereo system, the years on your life, the lollipop, and I'm going to give you the 60,000 each, and I'm going to keep all the change. Is that okay? Well, I'm the bank, too bad. So here we go. Play it out for me. Just go. So by the time you're 95 years old, we're sitting at $320,000. So you guys just paid me $260,000 for a cheapo surround sound system for your TV. The years on your life might have been worth it, but you know, that's not a very good deal for anybody, right? But did you expect that to happen? Not at all, right? Nobody does. That's crazy that it would go from 20,000 to 320,000 with just tripling the interest rate. That's only 4 percentage points difference, right? So let's go one more time. Yeah. Yes. So I'm going to give you 8% now. Much better deal, right? So 72 divided by 8 is every 9 years. So this time all I did was I increased it by 2 percentage points. I didn't triple it, just 2 points. Then I decreased the doubling time by only 3 years. So at 95 now, same 23, same $5,000. What are you going to have at 95? If you had 320 right here. 2 percentage points, 3 years less. Just take a shot. 900? All right, from 60,000 to 900. I like your attitude. You're good. You're locked in. Final answer. You're good. Rob, what's your guess? In the somewhere in the millions. There's a lot of millions. 1.5 million. So you're going from 60,000 to 3.5 million. I'm gonna call you off whenever I need an energy boost. Get some positive.
We're talking about 95 though.
Yeah, we're talking about 95 from 320, only 2 percentage points, and 95 years old. And I only decreased it by 3 years.
$940,000.
940. So we got 900, 940. Going once, going twice. Closing out the deal. Here's the deal. I'm going to give you that money, give you the stereo system, and I'm keeping all the change.
Of course.
All right, give me the shit. And we're at $1.28 million. You're excited about that, right? You were close, except this time you were even further off than you were last time. You paid me more for that Bluetooth stereo now than you did over here. Yeah. Think about it, 960,000, what is that? 40,000 plus 280,000, that's $320,000, which is this entire sum right here that you paid me for the stereo. So that's pretty ridiculous, right? I mean, did anybody ever learn this? You guys ever learn about this in school? Nobody ever taught anybody this. Why? I want to know why it is that people with masters in business, MBAs, come out and have no idea what the Rule 72 is or how it works. Because if you're putting your money away and trying to grow it and save it for retirement, don't you think this rule is pretty darn important to understand and know? It's how money grows. Yeah. And if you're not growing your money, you're not going to get to where you want to be. So if you had your choice of these 3 options, you got A right here, you got B down over there, which one are you going to want to choose? Obviously, right? That's a rhetorical question. You don't even have to answer that. That's where the money is. So obviously, we're going to choose that side. So what's even going on here? How is this related to reality? The Bank of Ryan isn't real, right? But interest rates are real. Savings vehicles are real. Retirement is real. It's going to happen one day. So you're putting money away. If you're putting it in the bank or under your mattress, you're over here. You're in A column. You're like, where do people go when they get a paycheck? They go straight to the bank, right? They direct deposit it straight into the bank. And then so the bank's going to pay you 100 times less than this example right here. What do you think the bank's doing with the money that's sitting there in the bank? They're going with B, right? Obviously, they're going with B. So let me get this straight. You're putting your money in the bank, direct deposit. You're so excited about it that you don't even want to see the money. You want it to go straight into the bank. $20,000 is what they're going to give you at 95 years old, and turn around, they're keeping $1.26 million of what could belong to you and your family and all the people that are important to you in your life. So is that even morally right at all? How is that even legal? It's crazy. Isn't that nuts? It's legal because they build 4 walls, you walk through the door and you hand them all your money and don't ask any questions. That's what we do, right? So here we are in this scenario. The banks, you go to a big city and you look at the buildings, what's on every one of them? Banks, mortgage companies, insurance companies. Why is that? Because we are all building them, maybe individually, because we're giving millions of dollars away to other people just because we don't know any better, right? And we call this legalized extortion, because extortion meaning theft, right? Extortion is like a gut punch. It hurts to even listen to it or say it. But that's the reality of what we're dealing with. Because people don't know, where do I go to even get 8? And how is the 8%? How is the bank even making 8%? Well, think about it. You got any credit cards? You have any credit cards? No? Raph, you got any? Well, that's cool. But a lot of people that you know probably do, right? And they probably have a ton of credit card debt. There's plenty of people out there that do, right? Or mortgages, or car loans, any kind of debt that you could ever imagine. So the bank, what are they doing with the money that you put in there? They're lending it to other people. Credit cards have interest rates of up to 33%. So think about that in terms of Rule 72. 72 divided by 33 is what? Just over 2 years. So the bank's turning around taking your money and doubling it every 2 years. This number is not $1.28 million. It's like tens and tens of millions of dollars that they're keeping at the expense of all the people. So how do we go and make, so we have this knowledge now of the Rule 72. And anytime I learn something, I want to be able to apply it to my life and make it work for me. And this is what actually got us into the business years and years ago, was this rule right here. So first and foremost, we know that the Rule 72 is working for the banks and the people that are keeping us in debt. So we got to stop making the Rule 72 work for them, and then take the knowledge that we have and make it work for us instead. Am I right? You guys agree?
Mm-hmm.
Okay, cool. So first we're going to talk about, give me a click chain. We're going to talk about debt just for a minute. We're going to show you a very short video that talks about mortgages, but it applies to all kinds of debt. So stop making the Rule 72 work for everybody else. Start making it work for us. Step number 1 is get out of debt. So, you got this, you want me to do it? I got it.
Oh, you brought up the YouTube? I got it right here. Okay. There we go.
Did you know that millions of Americans are overpaying their mortgages? And not by a little, by tens of thousands, even hundreds of thousands of dollars. That's right, and it's all in interest payments. The fact is, most Americans could be living the lives they've always dreamed of if they weren't spending the majority of their adult lives paying for the lives their lenders have dreamed of. In this video, we're going to show you how overpaying your mortgage is robbing you of the future you could have, and what you can do to stop paying for somebody else's dream and start turning your financial dreams into reality. So let's get started. Meet Bob and Katie Smith. The Smiths own their own home, and they're in a pretty typical mortgage situation for millions of homeowners across the U.S. Your individual mortgage details may differ from this example, but the financial principles remain the same. Bob and Katie have a 30-year mortgage for $200,000 at a 4.5% interest rate and a monthly payment of just over $1,000 per month. Bob feels like they're pretty lucky to get a 4.5% rate. I mean, that's a great deal, isn't it? Well, to answer that, let's take a closer look at that 4.5% interest rate. How much of the Smith's payment every month is going toward interest, and how much is going toward principal? By the end of the first year, they've paid their lender more than $12,000. Of that, nearly $9,000 went toward interest. That means that over 73% of the money Bob and Katie paid their lender in year one went toward nothing but interest. That's 73% of their payments up in smoke. And in year two, it doesn't look much better. Once again, Bob and Katie paid their lender over $12,000. And of that, more than $8,700 went toward paying interest. That means that in year two, over 72% of the Smiths' money went toward nothing but interest. Now let's fast forward to year 20. By year 20, Bob and Katie have paid over $243,000, but they still owe their lender over $97,000 in principal on their loan. That means that after paying all that money, the Smiths still owe almost half the original amount they borrowed. And by year 30, the amount Bob and Katie have paid their lender totals almost $365,000, of which nearly $165,000 went toward paying nothing but interest. That means that they've paid their lender over 82% of the amount they originally borrowed just in interest payments. That's 82%. Quite a far cry from the warm and fuzzy feeling the Smiths had when they heard they got a 4.5% loan. So where do all the billions and billions of dollars homeowners are paying the banks in interest go? Exactly. Homeowners like Bob and Katie from all across the nation spend their lives making interest payments to the banks and wonder why they never get ahead. But guess what? It doesn't have to be this way anymore. What would you say if someone told you that there is a simple online banking solution helping homeowners like you put an average of 18 years or more worth of mortgage payments back in their own pocket? How excited do you think people like Bob and Katie would be if instead of having to pay the bank over $164,000 in interest payments, they could pay less than $63,000, the same amount of interest they would pay if they had just a 1.9% fixed rate on their mortgage? That's nearly $102,000 in interest payments they would save, and their house would be paid off free and clear in just 12 years versus 30. Thanks to our online banking solution, Bob and Katie would be done making mortgage payments in just 12 years. What could you do with over 18 years of mortgage payments you no longer had to pay to the bank? Just imagine the possibilities. And you don't have to refinance. You don't have to change banks. You don't have to increase your minimum monthly payment. And you don't have to modify your mortgage or change your mortgage terms in any way. Just imagine the freedom you would have if you no longer had to make mortgage payments to anyone. Don't waste another minute. Watch the corporate.
Okay, so we're talking about debt, right? And that's a mortgage. Does anybody have a mortgage in here? No, not yet. You know, when you go to buy a house, what do you usually have to do? Take out a mortgage unless you're doing something right and you can buy it cash. Because then you don't have to avoid all this. But listen to what's happening. So I send you a flyer in the mail, and the flyer says, guess what? You don't have the money to buy a house, but I'm going to lend it to you. And you don't have to pay me back for 30 years. It's going to be great. Take your sweet time. You know, don't worry about it. I'm going to lend you all the money. I'm going to purchase it outright, and you just got to pay me payments every month for 30 years. No big deal. Here's the catch, though. The house costs $100,000, and I'm going to charge you $100,000 for me to lend you the money. So you're paying for a $100,000 house for $200,000. Do you want to pay that now? Does that flyer sound really great? No. So how is it that they're doing it so well? There's tons of people with mortgages, And if they only advertise it accurately, how many people do you think would go and run to take out a mortgage? They hear the jingle of a key and then they're like, give me the paperwork, let me sign it. I don't care, give me the house, I'll pay double. But they don't even realize that that's what they're doing. So the same thing doesn't only apply to mortgages, it applies to credit cards, it applies to cars, it applies to student loans, it applies to any kind of debt that you could possibly ever imagine. What is this that we do? This is a debt program that we have helped develop over years. And really what it is a GPS system. Do you use GPS to get here? You rode with that guy. Yeah. But if you didn't, you probably would have, right?
Yeah.
You've used it before.
Yeah.
Okay, good. And what does it do? It tells you how to get from point A to point B, right? Exactly how to do it. And if you go the wrong way, what does it do?
Tells you to redirect.
Redirects you right back on track, right? And all you got to do is follow a simple set of instructions and it gets you right to where you want to be every single time. That's exactly what this is. It's a financial GPS that takes into account all the things that you have going on, your debts, your income, your investments, anything you got. It's going to put it into a calculator and give you step-by-step instructions on what to do on a daily basis in order to cut down and eliminate your debt in the most efficient and fastest way possible. And we're seeing people that are slotted to pay their debt for 30 years and pay $200,000 in interest alone. So they're paying for what they're buying plus $200,000 additional. Instead, by using a simple set of instructions and a GPS system, they're out in 7 years and saving themselves 180 grand. Who in their right mind wouldn't do that if it was guaranteed to the penny in the second? It doesn't make any sense not to. So for us, this is a great opportunity to help people in terms of helping them get out of debt so they can start putting money away and making Rule 72 work for themselves, right? So next thing is, where do you go to get that 8%? How do you start making it work for yourself? You're out of debt and now you got to save. You should have been saving anyway already. But this is going to be another short video. This one's even shorter. That'll give you a concept and talk about a lot of things you already heard.
So pay attention and make sure you ask some questions because it's a really good one. Here we go.
Hey, thanks for joining me here. I wanted to give you a quick snapshot on what it is that we're doing. This is a snapshot of our program, Red Line, Blue Line. Not knowing anything about anything, if you had to choose one of these two lines to put your money on, would you choose the red line or the blue line? The blue line, of course, right? Because it's more money. If you look closer, what you realize too is that it never goes down. It only goes up. Never go backwards. Gains are locked in. But you know, the story gets better than that. In addition, that $211,000 is income tax free. The red line is the Standard & Poor's 500 index. That's the stock market, 500 of the largest stocks in America. And if you look at this 165, about 95% of mutual funds do not outperform the Standard & Poor's 500 index, meaning that most people in mutual funds, 401ks, IRAs, so on, actually had less money than the 165. But we still have to deduct fees because fees didn't come out of this. The average fee is about 3%, can be anywhere between 1.5% to as much as 5%. Many people aren't even aware that they're paying these fees because they're hidden in what looks like a phone book written by a Philadelphia lawyer called a prospectus. But when they examine that, the Los Angeles Times said the average is about 3%. And in this case, on $100,000, that would be about $3,000 a year in expenses that you have to pay, by the way, whether you make money or lose money. And if we just roughed the numbers out and said $3,000 on $100,000 over 15 years, means you'd have to subtract $45,000 out of this number. But we still have to take taxes out. And if you even looked at a 10% or 15%, 20% tax bracket, you know, very conservatively, you're about where you started 15 years earlier. Now, you put up 100% of the money, took 100% of the risk, and ended up about where you started 15 years later. I want you to think about this. The mutual fund company put up zero money, took zero risk, and they made $45,000 in the process. $17 trillion today is on the red line in qualified plans. That's 17 trillion with a T. Without anyone spending one additional dollar, don't you think that most people would prefer to be on the blue line? In addition, this comes with all sorts of other benefits. This is net of fees, charges, expenses, and it's also income tax free. So here we have a smarter, more complete alternative to 403b, 401k, IRA, mutual funds, to the stock market, where you don't have the risk. By the way, that $211,000 is guaranteed never to be less than that. It can only go up, never go down. In addition, there's other benefits that come along with it. When you look at the whole package, it's, again, a no-brainer. Scott, of
So how, you might not have captured all of that, but I'll tell you what you're looking at right now. This red line right here, he said it in the video, right? Red line is the S&P 500. The S&P 500 is the top 500 companies in the country. And that's the main index and barometer for how the U.S. economy is doing at this point in time. So if you hear on the radio or the news, the S&P 500 is up today, that means that the top 500 companies in the country on average increase their value. Or it's down today, they decrease their value. And you can gauge what's going on in the U.S. economy by watching that line, kind of. And this is what's happening. 97% of people's life savings are within that red line in some way or another. They're in that red line. So if you had $100,000 saved up in an account, today you would have lost $2,000. Poof, gone. That's what happened today. We've lost 2 percentage points, right? 2? Yeah. 2 points on the S&P 500 in a day, today, which is devastating loss. So $2,000 out the window, I don't know how many people can afford that. I don't want to lose that much money. So that's what's happening. And you can see, if you remember 2008 and the whole economic crash and the recession, yeah, it's right here. You can see the trends. 97, we went up. Then in 2001, the dot-com bubble burst, right? And we had a crash. And we went up again. And then 2008 happened and the real estate market fell out from under us and we had another crash. And where are we right now? We're way up here. So if 97% of people's life savings are wrapped up in that red line, we're at the top of a large hill. The next step is what? Going down the other side, right? So everybody you like, love, know, care about that has a large sum of money or is older and getting ready to retire, or has been saving for several years, today they lost a significant chunk of their savings out the door. And I guarantee they probably don't even know that happened. So they need to be aware of these kinds of things. So we talked about market loss. That's one. You see the blue line. When the red line goes down, the blue line doesn't, right? Pretty valuable, right? So you're getting the gains, not experiencing the loss. Then he's talking about fees and commissions, which we talked about before, right? Some guy is putting your money in this red line and playing with it. You're paying him for it. And a lot of people don't realize that either. So he said at the end, you subtract a lot of money out because you're paying somebody the whole time, right? So fees and commissions takes away from the red line whether you win or lose. Then at the end, when you're left with 165 and you started at 100, you're paying taxes on top of that, and you end up with less than what you started from 15 years of savings. Not a good plan, right? Blue line, you get to the top, there's no taxes, the fees are half as much, and you never have to experience any market loss. So that's what we do. We teach people how to get out of debt. We teach people how to save their money and keep as much of it as possible. And what we're going to do right now is show you another, rather than me explain what blue line is for 10 minutes, I'm going to show you the South Park edition of what this red line, blue line actually is. It's actually pretty cool. South Park edition. Hey, this guy looks like a South Park guy.
He does.
No way. Yeah.
When it comes to retirement planning, there are 3 kinds of people. The guy who doesn't think about or plan for retirement, you don't want to be that guy. The gambler type who feels the only way to grow her money is to risk losing it all in the stock market, and the play it safe type who shudders at the thought of losing a single penny of his savings, even if it means sacrificing any opportunity for that money to grow. For years, retirement planning has been vastly limited to choices that fall on one side of the scale or the other. And so, money-savvy people tend to invest in 2, 3, 14, 50 different products in an attempt to balance the scale. But what if there was a way to capture the upside potential of a risky product and the downside protection of a secure product all in one solution? Well, hold on to your potatoes. Let's talk about IUL. Index Universal Life can harness the best parts of both sides of the financial seesaw. IUL is a form of permanent life insurance that, whoa, hang on. Life insurance has changed in the last 20 years. You know it as something that just pays out when you die. But these days, life insurance can actually be one of the most powerful wealth accumulating vehicles on the market. One huge benefit of IUL is the ability to harness the power of compound interest to potentially generate large amounts of non-taxable cash value within the policy. This cash value can be accessed later in life to fund a happy, healthy, non-taxable retirement. Your IUL's performance directly reflects the performance of the stock market index, while implementing a 0% floor and a market cap, usually around 10%. So your cash value participates in the growth of the market up to the cap and sits safely on the sidelines when the market goes down. You forego some of the upside to alleviate all of the downside. So zero is your hero. With IUL, you won't spend a single day of your accrual making up for losses. Pretty cool, right? Well, it gets better. When designed properly, IUL can serve as a retirement vehicle based on a financial chassis of life insurance protection. And because of IRS tax code exemptions for life insurance, your cash value can create a tax-advantaged way to generate more income in retirement. That's something your 401k or IRA simply can't offer. So what might an IUL look like for you? Let's talk specifics. Larry here is in decent health, a non-smoker, and contributes $500 a month to his IUL starting at age 35. This contribution is conservatively projected to generate $500,000 of cash value by the time Larry retires at age 65. If he chooses to, Larry can turn on a non-taxable income stream from his IUL, giving him $60,000 of income per year to supplement his retirement. And the longer he waits to access this money, the larger it can grow. That death benefit is even accessible when Larry's still living if he suffers a critical, chronic, or terminal illness. So if Larry gets sick, he's covered. If he dies unexpectedly, his family is covered. And if neither of those things happen, the money Larry's paid into his IUL over the years can fund a happy, healthy, tax-advantaged retirement. Assuming Larry lives to age 90, he will have contributed a total of $186,000 into his IUL, drawn out $1.5 million in non-taxable retirement income, and still leave behind a very sizable tax-free death benefit for his heirs. The person who shared this video with you can show you what an IUL might look like for you, given your specific age, health, contribution level, and retirement plans. Contact them today to get the specific numbers and see if IUL is a fit.
Good.
Like everything's a hold your potatoes.
Hold your potatoes.
Yeah, I heard that too.
So,
So that's one of the products that we work with. Every story is different. You know, we analyze and assess people's individual scenarios and show them how to best move from where they are to where they should be so that they're left in the best situation possible when they get to the time where they're going to have to rely on the money they're putting away and getting out of debt. So what that's called is an IUL. I said it in the video. We don't have to go through it because it mentions that it is a product that's linked to life insurance, and I'll give you a very quick rundown of why that is. So what it does is defends against market loss, defends against high fees and commissions, tax loss, declining health if you get sick, and estate taxes, so you can pass it on to your family free of tax. The way that this even came about is, number one, back 50, 60, 70 years ago, the tax code was written. Nobody in here has read it. None of your accountants have read it. It's 93,000 pages long. So that's absurd and ridiculous. Just so happens that there's a couple tax codes in there, 7702 and 101. You can write those down if you want to look them up. That says as long as you wrap your money around a life insurance policy to a certain ratio, you can grow, put your money away, grow it, and pull it tax-free. That vehicle, there's rarely another vehicle that does that. So growing, all the growth of and earn your money is tax-free, and you withdraw it all tax-free. That's great. So next thing that happened is in 76, John Bogle invented the concept of indexing, which is investing your money in market averages rather than trying to gamble in the market, because gambling doesn't make sense with your life savings. It's just kind of stupid. So indexing is a very smart way to keep a very low cost and get the best returns that you can. 1999 Financial Modernization Act happened that allowed insurance companies to compete with brokers and banks, and gave them the ability to develop products that are more dynamic and complex and can meet the needs of a lot more people. So in 2000, the IUL was developed, and in 2004, it was kind of perfected. And here we are today in 2015, where it's still improving. 16 now, holy smokes. So the IUL is a very, very powerful product that we provide to people to find solutions for what's really wrong with their savings plans. The Swiss cheese finance is what most people have going on. We're able to plug and fill those holes and really create a better scenario for people and an opportunity for ourselves. So let's go. Oh, one more trick. Yeah. So the one of the biggest parts of this is the declining health part, and that's called living benefits. Very new to the country, very unique opportunity to protect the people you care about. So for that, I'm going to bring up Trey to talk about that.
All right, I'll be very brief, short. Gabby, you and I briefly spoke about this on the way up. And Francisco, you've been here before, I know. This is why I'm in the business. You know, this is my passion, and everything that drives us is backed by passion in some way, shape, or form, in my belief. Because I want to be here because of this right here. It's living benefits, and I don't have to ask you, Gabby, because I know you just told me your father had a heart attack not long ago, so you know somebody that's had a heart attack and survived. And was he younger than? He's younger than 65, right?
Yeah, he's like
60? 62, okay. So, and I asked Gabby on the way up here, I said, you know, do you ever wonder if that's going to happen to you? You know, do you think you'll have a heart attack, or do you think you'll have a stroke someday? And he said, yeah. And it's a fact. You can see right there, it's 7 out of 10 people are going to have one of those big three before they turn 65. Heart attack, cancer, or stroke. So it's going to happen to 7 of us at least in here. There's over 10 of us in here. So 7 to 9 people are going to have one of those big three. And if that were to happen, you know, I'm picking on you, Gabby, because you're the only one not in the business, or Francisco. If it were to happen to you now, how would you be able to live the same standard of lifestyle that you're living now? Yeah. No. And you even told me that it kind of affected your parents a little bit too. Yeah. So what living benefits is, you know, you have the life insurance. So say you have the $100,000 death benefit and you have a heart attack. You now have access. You no longer have to wait to die to get that money. You have access to that money when you need it the most. So in the case that you become critically, chronically, terminally ill, you have access to that $100,000 when you need it the most. And just a quick story how that actually came about is there's this true story. The Bernard brothers, they started open heart surgeries and major organ transplants, did a lung transplant on a lady. Just to catch you up real quick, Raphael, I'm going over living benefits and what it is, how beneficial it can be for your family. It's my passion. I'm going to share my story with you. Do you happen to know anybody younger than the age of 65 that's had a heart attack, cancer, or stroke and survived? Nobody. You're one of the very few. So I'm gonna keep going. What happened though is they did a lung transplant on this lady, and this true story. She was in her mid-30s. She received the lung well, and they said, "Look, you can't go to work. Just rest, recover, recuperate, etc." She came back some months later for a checkup, and she just looked like death. And the doctor said, "You know what's going on?" And she said, "Doc, you don't understand. I have 2 kids. I'm a single mother. I gotta eat, or they gotta eat. I gotta work. I don't have a choice." So this lady just had a lung transplant, and she's already going back to work. Is that acceptable? No, not by any means. And what happens is it caused more stress for her, and long story short, she died. And she had life insurance, and her kids got paid out. Now, Gabby and Raphael, do you think those kids would rather have their mother? Would they rather have their mother or the life insurance money? Amen. 10 times out of 10. And that didn't sit right with the Bernard brothers, so they actually went over to the UK where they have a big influence with the insurance companies, and they said, look, we're over here saving people, and you're over here killing them. Majority of life insurance companies are what you call legal reserve companies. So say you have that $100,000 death benefit, they have to have 103% of that money at all times from day one. That's what their job is. They're in the protection or distribution business. So their job is to pay you. They said you already have the money, so why don't you just give it to them when they can use it the most? And that's where living benefits came into play. So now you no longer have to die to benefit from your life insurance. And there's 150 million, right, Coach, or 49? 149 million people right now that have life insurance that they have to die to benefit from it. If they had their choice, do you think they'd rather have living benefits? Same cost, nothing different, same dollar, just better services. Don't you think they'd rather have it? Excuse me. And out of 2,700 different life insurance companies, there's only a handful that offer these at a no-cost rider. So it doesn't cost anything extra. And there's 149 million people right now that need our help. Because you can see there, over half of bankruptcies are due to medical expenses. And 78% of them had adequate health insurance because the doctors get paid and the hospitals get paid. However, who doesn't? You, the person that's injured, the person that needs the money the most. You're sitting there in bed. How are you going to pay your bills? How are you going to keep a roof over your head? How are you going to feed your children? And that's where living benefits comes into play. And the reason I'm so passionate about it is because I actually seen it happen in my own life. My mother had a couple strokes and was bedridden for a while. She survived and you know, lasted a while. And then she ended up passing away. And from that, you know, just like Shane said, she actually had a bad estate. We got, you know, passed on a bunch of debt. We ended up losing our house and everything just went downhill from there. And so for me to see something like this is very profound, and to be able to offer this to people is why I'm here. And it's something that I stand behind, and I'll always stand behind till the day I die. Because people need our help. They need to know about this stuff. People, our generation, they don't think about saving money. They don't think about their future, especially people with families. How many people with families do you know, Lindsay, that aren't protecting themselves and their family? A lot. And I don't know about you. I don't want to be a burden on my family at all. And so to me, it's important to share this message with people so that they know it's available. And we've made a business opportunity out of it. And if I'm going to work somewhere, I want to get paid well. And this just happens to be the highest paying industry in the world. So why not? And to go ahead and close this out, I'll go ahead and bring Coach up. I don't think I forgot anything. It's been a couple weeks. I took a leave of absence.
A little rusty, right?
Yeah. But thank you guys for your time. Appreciate it. I'll go ahead.
Are they still on in TV land up there in the Northeast watching it? So Happy New Year to you guys up there in the Northeast. So I'm gonna turn things around a little bit tonight, okay? Because I'm listening to a lot of new people, and it's always intriguing to me. How many of you hate really people that are overly arrogant or ignorant to you? Anybody in here? Yeah. All right, we all normal? Now, I want to make it clear that ignorance doesn't mean that we're stupid. It just means we've been uninformed. And people can act, but once they're informed and they keep that same posture, what's it make it then? Okay, remember you all said that. Okay, it makes them stupid. So and arrogance. How many of you just resent arrogance? There's no reason for it, right? Raphael, is it? Yeah. Raphael, what makes people arrogant? Maybe. See, that's a perception. See, now I don't agree with you because I hang around a lot of people who make money and they're perfectly nice people. People that resent people with money, that tends to be arrogant. Boom! See, look at Ralphie. You just turned that around on me? Yeah.
My boss, he's a millionaire, lives in Sanibel Island, has everything he wants, and he's a little arrogant, you know? I don't know.
I don't think he should be, but that's great. But see, don't judge every book by its cover either, right?
No.
So here's my point. I want to move on, but I'm just bringing it out. I'm just trying to stimulate your thinking. Okay, how many of you ever heard, I just don't trust them? How many of you don't trust? It's amazing. Raise both hands, Lindsay. Thank you very much. Do you have feet you can raise up too? Okay. Lindsay doesn't trust anybody, anything, anytime, and she's in the club with Joyce. Boom. I mean, that's the deal. Okay. So, are you listening, Francisco? Because that's the truth. All you, like Rosemary, I'm talking to Rosemary too. I don't trust them. Okay, right? None of you trust anything, and yet you do everything that you don't trust. You kill me. Okay, for instance, the lack of information that we have, Gabby, is incredible. You know how many people are working jobs right now? Like, what do your father and mother do? Do they work?
Well, my dad's retired now. He was a mechanic for like 30 years in Metro-Dade County, and my mom works as a ESOL tutor at high school.
Awesome. And they work for a job, and the job usually gives them benefits. Has anybody ever heard out there, I'm working a job for benefits? Talk to my wife. That's all she ever said. Benefits. I want to get a potato and, you know.
Yeah, I hear like a lot of people will be like, oh, I only get paid this, but I got good benefits.
Yeah, until they get sick and they find out how much they got to pay, especially with the new deal going on. See, there I go. That's exactly where thank you very much. You see how many people are ignorant about the truth and they don't trust anything, and yet they're doing everything that puts themselves in a place that they ought to not trust? For instance, why would they all, now I'm going to tell it to you straight. All the people that you know that have IRAs, 401ks, 403bs, things called qualified funds, that's what it means. Now, if you're new and you're hearing all this language, it can get confusing. So we're going to take our time just to make sure you get that. So that's what qualified funds are. And companies give them as benefits. Everybody takes them because they think they're getting something. Why would you give away control of all your money? Would you, Gabby, willingly?
Yeah.
That's what people are doing every day. Your parents did. They don't have any clue. Ryan went through the example on a mortgage. Now, listen to this. I just want to ask the question. If we can turn, and Ralph, you got to answer this question before you go. He's got to go ahead.
I want to smoke cigarette.
Okay, priorities in life, right? Okay, very good. Okay, look at that. Okay, I'm right here, Lindsay, all right? So here's the deal. I lost my thought. Where was I going, Ryan?
Brian went through it with the mortgage, so.
Yeah.
Yeah, I have a question. If we can totally, Lindsay, pay attention now, listen to this question, wrap around and turn around and reduce all of your debt, including your mortgage, including all of your credit cards, let's say. Imagine having your car payments, whatever, all the debt that you've got that you're paying for somebody else. If we can wrap it all together and reduce the interest rate below 2% without refinancing or having to go out and redo anything, is there any reason why you wouldn't do that? Gabby, would you? Is there any reason you wouldn't do that?
Yeah.
Below 2%. Is that good or great?
Great.
Gabby doesn't know. Watch. Gabby, you know what people are paying on an average on a credit card? You don't have a credit card. See, you're 23. Your parents got credit cards. Ryan just showed you. Some people with great credit, they can get it down for maybe even 0 to 6%. Okay? The highest that people are paying are 33%. Is that ridiculous? So if we can get your interest rates 6% to 33% to below like 1.9% or lower, is there any reason why you wouldn't do that? Imagine that. We do that. Gabby, for $125, would you invest $125 and we can show you how to reduce your fees that you're paying everywhere by $100 a week for the rest of your life?
Yeah.
Okay, thank you. See Trey tonight. Did you hear what I just said? $125 investment in your life. We're going to show you how to save $100 a week for the rest of your life. Now pay attention, come here and learn. Because here's what we do. We're exposing this thing about trust. Nobody trusts anything, and it's so funny because that's what they're doing. They're trusting their money to the banks, to the mortgage companies, to the insurance companies, and we think it's the biggest scam and perpetrated in the United States, in the American public. We have a crusade, and what Trey just talked about, living benefits, it's the biggest thing I know about in years to be created. It's only 10 years old. So we have a mission. We have a bunch of very successful people that have worked for years that were retired already that came back out to share this message. Now, does anybody have an FIP? Because I'm going to show you what we wind up doing. Okay, we wind up creating what we call, that's you can pass me up that, an FIP. See, Gabby, we believe two things. What are the two dates, William, that everybody ought to have?
Debt-free day and financial independence day.
Everybody ought to have those dates, Gabby. Now, if you go home and ask your parents, hey, Dad, you got a debt-free date? He's going to say, go to your room. You paying attention, Gab? See, go to your room. You're talking to your dad about being debt-free. I mean, you're 23. He raised you. You're sleeping in his house, right? Good. Okay, I just thought. So you got my point, though?
Yeah.
So it's incredible. So what people want to know, they have to learn, and we bring it to them because they're doing all the wrong things. Now, where was I going, Trey? I just lost my phone again. What's that?
2 days.
Oh yeah, debt-free date. Debt-free date's a big date. Everybody should have one, but nobody knows how to get out of that. Second thing is everybody like to be financially independent, wouldn't they? Everybody. You don't want to have to work for money. It's very smart for you to have money work for you. And you ought to work for a passion if you could. Make sense? So we make what we call FIPs, Gabby, and you might say for the people in TV land what that means.
What's that? Financial independence plan.
Yeah, I have one. Do you have one? Would you like one?
Maybe.
Maybe?
Well, you inform me of it. And
Let me do it again.
about it.
Do you have one? Remember, watch what he said? Now, see what he said, Francisco? Now I'm at home with Cabo. I said, what 2 dates do you want? A debt-free date and a financial independent date. Then I just asked him, does he have one? He said, no. Then I said, would he like one? See, that's his trust now going all up. He's exactly who we're talking to in this world. Because I don't know, would you like a financial independent date? Yeah. See, if you don't, you're going to be broke. How's it being broke, Gabby? How's that working for you? Sucks. Why wouldn't you want that immediately?
No reason.
Right, except for mañana, I'll get around to it. That's why people win and people lose. We're looking for some people that have some sense of urgency, that want to be able to impart information to people. That's the opportunity side. Everybody needs our services. So we do 9 out of 10 of our people that we help do so without spending any new money out of their pocket. Why? We are willing to show people at least 101 different ways that they're absolutely wasting money. Do you like wasting money, Gab? Lindsay, do you like wasting money? No. When you find out about it, do you resent that you're being a knucklehead? See, do you feel like taken advantage of a little bit and when people just take more than what they should and you're doing something silly when you could have saved a lot of money with practical sense? See, that's what we do. We just bring common sense to the table. We disturb the comfortable and comfort the disturbed. That's our mission in life, Gabby. Does that make sense? So in this case, this is yours, Trace, that I just picked up in my hand?
Yeah.
Okay.
My concern's not in there though.
Oh, man, so you screw me up. So you give me a bad deal here, okay? So I don't know where to go right for the bottom line.
Right there. You skip it.
Okay, so he's paying $100 a month. Now, most cases, it's not even out of his own pocket. So we found money for him. So he didn't have to pay for this. He was already squandering money. We just moved it from A to B. Does that make sense, Gab? So here's what he gets for that. For his $100 a month, he has $52,000 worth of a life. Yes, Dan.
How do you? All right, the $100 you're paying a month, you just said you moved it from A to B. Where'd
it come from?
Yeah.
That's what we sit down and examine everybody, what they're doing, because they're all doing silly things. For instance, did you get a tax refund check last year?
Yeah.
You did?
I don't know.
Did you work a job last year?
Yeah.
Did you get a tax refund check?
Like the W-2?
No, did the government give you back a check at the end of the year?
No. I don't know.
You might not have filed taxes.
No, I did my taxes. I went to H&R and yeah, I got a check.
That's what I'm asking.
All right, yeah.
Right. But see, Gabby being 23 is still like, no, you're, and it's okay. Is this waking you up?
Yeah.
See, you ought to be a little disturbed right now. Remember, we comfort the disturbed and disturb the comfortable. You've been comfortable. You can't be comfortable doing that. And watch, you got a check back from the government, right?
Yeah.
How much was it?
It was like $900.
$900, almost $1,000, right? Now, you were giving them the money every week out of your paycheck, right?
Yeah.
Okay, great. And they saved it for a year. And then when you asked for your money back, they delayed you for another month, didn't they?
Yeah.
But you finally got it. How much interest did they give you on that $1,000? You don't know? Well, can I help you with it?
Yeah.
Shouldn't you have known?
Yes.
Okay, just checking. See, Gabby, don't get mad at me. I'm not picking on you. This is the education.
I'm not mad at all.
Okay, are you learning?
Yeah.
Okay, watch. This is how much they gave you. How much did they give you on your money?
0.
Can you say that again?
0.
Wow, how'd that feel? How's it feel to get what?
0.
Hey, I get 0 on my money. I am 0. That's disgusting. You gave your money away for a whole year. They held it, gave it back to you with 0 money. Does that make any sense to you?
No.
Now, if you owed them money, would they let you do the same thing?
No, I don't think so.
Exactly. Then why are you falling prey to that? We're going to fix that. There's $100 we just saved you, just like that. See, because what you don't know will keep you broke. And when you went to work and filled out the forms, you didn't put down the right numbers because you didn't know any better. Nobody taught you. Nobody educated. Your parents don't know it either. Okay, because nobody taught them either. They don't teach this stuff in schools. This is a school of hard knocks. That's why we're good at what we do.
He's that $900, like that's free money. You know, like I had a $1,500 tax refund. That's exactly what he's talking about. So it didn't affect my budget at all. It was squandered money. That money was sitting in the government doing nothing, and now it's in an account working for me. So it's
Clear?
a choice.
So watch. So you get 52,000. You got a term rider on here too. How much is that?
$250,000.
So you have $250,000. He's got $250,000 worth of insurance, and he's got well over $200,000 if he becomes sick or disabled, whether chronically, critically, or terminally, with 16 different modalities. He'll be able to access over $200,000 at retirement. At retirement, when he turns 66, where are you here? At 66, he's going to be just about $39,000 a year tax-free. He's going to make. He makes that now working about 40 hours a week. Okay, he won't have to do that. They'll pay that for the rest of his life for only $100 of money that he didn't have to pull out of his own pocket. Is that good or great?
That's great.
Exactly. That's what we do. Everybody should have an FIP.
For instance, you go for 401k and do the same thing.
Okay. So one more point. I'm not going to show it now, okay, because of what's gone on. But we can show you how to build a business here if you're interested. One, you got to learn for yourself. Two, everybody needs our services. In fact, when you go to parties and you talk about things, how many of you ever talk about what you don't have? How many talk about dreams? Anybody talk about jobs? How many people, right? It's unbelievable. So what we do when we're building agencies here, we're teaching people how to build, but the first thing is to show people what we do. You know, we become a product of our own services. Everybody that's in this business has their own FIP now. We have a plan. They're all working toward their debt-free dates and their financial independent dates. And if you don't have one, you need one. Does that make sense, Gav?
Yeah.
Okay, that's exactly what we do. And by the way, you don't have it on the, is it there at all?
What?
I'll just show them what kind of income they can make if you bring that up real quick. Here's the potential. If you came in here and work part-time, Gabby, and we get you to a position in 90 days, I'm just giving you that because that's a target date. It could take you a year. It could take you a month. It really doesn't matter to us, okay? We don't care. But when you transact business in this business, this is only on the financial side. This is not even including the debt side, okay? Now, when the average client's spending about $300, remember that's $300 that we find out of people that they didn't even know they had. We just found $100 for you. Boom, without even trying on one issue. Imagine that. We keep looking until we can find as much. In some cases, Ryan's paying $38 a month out of his pocket. Although he's investing $250, we found the rest, but he had to supplement out of his own pocket because he's already doing the good things, $38. For $38, he's going to have $103,570 a year tax-free coming to him until he's dead after 66. Tax-free. He was a biologist for the state of Florida, and they didn't even pay him $38,000. He's making 3 times the amount now because of $38 a month. Is that good or great? Just checking. That's exactly, I agree. So watch. Going and showing people, A, this is what you're doing. B, this is what you could be doing. Same person, same money. Just go from A to B. If they elect to do it, we just help them make that decision. You make money. So the average invested by a client is $300. You can see that right there, right? Okay. So if we get you up to a level of called the VP level here by showing you what to do, and you help 2 people a month. That's all. Just 2. Does that sound reasonable to you? Yeah. All right. Raphael, if you understood what we're talking about, does it sound reasonable? Francisco? Yeah. Definitely. Watch. Helping 2 people a month makes you $56,000 a year. That's part-time. Now, if you were to start learning what we're doing and engage people, and they want to do it for themselves, and you built a little team, just say a team of 3 people. That's all. I'm just giving some simple examples. 3 people, all doing the same thing you do, helping 2 people a month. That would be a total of 8 transactions. Your income just went up to $121,000. Why is that significant? Because most people in this country, only 4% of the United States population makes $100,000. Your life will change when you're making that kind of money. Is the market big enough? Everybody that deals with money needs to know what you just saw. They don't need to be in banks. They don't need to be using the credit cards. They don't need to be in debt. They don't need to be having an IRA or 401ks. They don't understand it. We just show people what their options are. Then we encourage them to make a change. Does that make sense to y'all? And we gain their trust. We also point out that the very cynical thing of their nature is their lack of understanding. And they better wake up because we just do things out of habit. That's all it is. You got to break bad habits and get new ones if you want to be successful in life. Who agrees with that? Boom, that's it. What'd you like best, Gabby? What you heard tonight?
Why,